Good evening, everyone. It's really my pleasure to be sharing my views on the very hot topic of disclosures on related party transactions at a forum uh, as prestigious as BCS. So it's really my pleasure, and I thank Mr. Billy Moria, Mr. Shah, and the team BCS for this invitation. I hope at the end of the session we will have some better idea or the deliberation on various disclosure requirements on the around RPTs based on the recent regulatory changes that SEBI has brought in. So I will just share my screen, put up the presentation, and then we'll begin with the discussion. So in case during the presentation, if there is any problem, please let me know because I will not be able to see because the presentation is on here. All right. So the topic for today is disclosures of related party transactions. So while even the disclosure part is concerned, 1.5 hours is a task for us to be completing this discussion because the amount of changes or the criticality of the changes that have been brought in, it requires a very lengthy discussion, but I will try my best to make some proper sense out of the discussion that we'll be having today. Before I get into the discussion on disclosures, I thought it is better that I will brush up on the regulatory requirements on overall RPT governance first, so that during our discussion on the disclosures coming out from the ISF note, which is Industry Standard Forum note that SEBI has released recently. So from the regulatory point of view, from SEBI LODR point of view, related party and related party transactions are defined and have got a wider coverage, as we know, than the Companies Act 2013. So related party is every related party which is considered as a related party under Companies Act and the Ind AS. I'm talking about it mentions applicable accounting standards Ind AS because we are talking about listed companies. And it additionally also includes two categories where any person or entity belonging to promoter or promoter group is a related party irrespective of the shareholding of that entity or the person. Additionally, any shareholder who was holding more than 10% at any point in time during the previous year is also considered as a related party during the current year. So this is a coverage of definition of related party. Now, when it comes to related party transaction, conventionally what we understand a related party transaction to mean a transaction of the company with its related parties. But SEBI regulations as amended from 1st April 2022, the coverage is quite wider. It now looks at RPTs at a group level. So if I have to break down the definition of related party transaction in bullet points, the coverage is as follows. So related party transaction, the definition quite is aligned with the Indian accounting standards, where related party transaction means any transfer of resources, services, or obligation. Obligation is something that I'm emphasizing on because it has got some relevance when we will discuss the disclosure requirements. So any transfer of resources, services, or obligation between a listed company and its related party, between a listed company and related party of any of its subsidiary companies, between any subsidiary of a listed company and related party of the listed company, between any subsidiary company of the listed company and related party of itself or any of the other subsidiary companies of the listed company, and transactions between listed company or any of its subsidiaries with any third party not being a related party, where the purpose and effect of the transaction is to benefit the related party of the listed company or any of its subsidiary companies. So I've just tried to break the definition of related party transaction down in these 6 bullet points. The definition also goes on to say that the transaction will be a related party transaction irrespective whether the price is charged or not, and it will be a transaction, all the transactions taken together under a contract. Again, I'm putting some emphasis on under a contract because there is some relevance that we'll have when it comes to disclosure requirements and the discussion around it. Now, this is the identification of related party and related party transactions. When it comes to approval requirements, primarily there are 2 requirements. One is every related party transaction requires approval of the audit committee of the listed company. And when I'm saying related party transaction, because we have looked at the definition of related party transaction, it covers the transactions where subsidiary is involved and this related listed company is not even a party to the transaction. In terms of audit committee approval requirement, where it is broken down again in two categories, because RPT, as per the definition that we discussed, may be a transaction where listed entity is a party, or transaction where listed entity may not be a party. So in case of RPT, where listed company is a party, then every transaction requires prior approval of the audit committee. In case listed entity is not a party, then transactions involving subsidiary will require audit committee's approval of the listed company only if the value of the transaction is more than 10% of the standalone turnover of the respective subsidiary company. This is about audit committee's approval, and then subregulation 3 goes on to say that audit committee can grant omnibus approvals for transactions which are of recurring in nature. Moving on, the next approval requirement is of the approval of the shareholders. So every material related party transaction requires prior approval of the shareholders. Again here, related party transaction means transaction whether irrespective whether listed company is a party or not. And material RPT means a transaction the value of which is rupees 1000 crore or 10% of listed company's annual consolidated turnover, whichever is lower. Okay, now there are certain exemptions from these requirements, where transactions between a listed company and its wholly owned subsidiary and transactions between two wholly owned subsidiaries they do not require approvals. Now, in terms of approvals, this exemption is available, but when it comes to disclosure requirements, there is no exception or exemption given under the regulation. Every transaction means transaction even between listed company and its wholly owned subsidiary and between two wholly owned subsidiaries, all the transactions are required to be disclosed. Now, recently, under the amendment that SEBI has brought in December 2024, earlier because the RPT coverage is wider under LODR, which covers every transaction, including the remuneration paid to the managerial personnel or related parties, remuneration paid to directors. What SEBI has recently brought in December 2024 is the remuneration paid to directors and KMPs will not be considered as related party transaction except for the directors or KMPs who belong to promoter and promoter group. So that is the overall coverage. Now, once this context is set on what are the obligations in terms of overall governance of RPTs, we can now move on to our core discussion point, which is the industry standard forum note that is released by SEBI, which becomes effective from 1st September 2025. Now, the objective, as many of us may be aware that SEBI, every company, once we have regulations which are uniformly applicable, but the manner in which the matters are tabled before the audit committee, manner in which the transactions are disclosed to the stock exchanges in the annual report, there are some differences that are there. The views taken by different companies on various issues or different matters, those also may differ. So therefore, SEBI thought that there should be a common forum led by industry organizations, which will lay down certain standards, which will try and bring the uniformity amongst the disclosures that are made by all the listed companies. Accordingly, the ISF was constituted, and the industry organizations, ASSOCHAM, CII, and FICCI were part of it, led by their representatives. Initially, SEBI brought in the Industry Standard Forum original note in February 2025, making it applicable or effective immediately. And the note was very comprehensive. The coverage, if I can say so, it was to some extent it was impracticable, or it was not possible to be even implemented, because there was a bigger categorization made that the transactions between promoter versus non-promoter group, transactions which are impacting the balance sheet or P&L were also categorized, and a big list of 88 line items was provided, where for any approval required of the audit committee or the shareholders, the disclosures out of those 88 line items were required to be placed before the audit committee or the shareholders, as the case may be. Now, identifying the challenges, difficulties, or impracticalities to some extent, SEBI deferred the applicability of that original ISF note to 1st July, and then taking the inputs from the industry associations and various professionals and the industry practicing professionals, SEBI came out with this revised ISF note on 26th June 2025. Now, what does this note do is this note brings in clarity on applicability and exemptions, which was lacking in the earlier note. It simplifies the categorization of the disclosure requirements and puts a little more clarity on the disclosure requirements, although it is not ambiguity free, and that's where the deliberation is needed, and that's where we are having this discussion today. And it aims to try and provide uniformity and adequate information so that audit committee and the shareholders, as the case may be, are capable of taking informed decisions based on these disclosures. Then it also prescribes and provides clarity on the procedural aspects of it, including the certifications, internal certifications by the management and external certifications on the valuation, etc. So I will, in the course of our discussion today, I will call the current regime or the current requirements of as new ISF note. Now moving on, in terms of applicability of this ISF note, although because there was anyways a deferral and the new financial year has begun, in my individual view, it is always better to have the applicability triggered either from the beginning of the financial year, which is 1st April, or at least beginning of the half year, which is 1st October. But SEBI decided that this will become effective from 1st September 2025. Now there is one respite given, although it becomes applicable in between the quarter or in between the year, in the middle of the year. There is some respite provided that the ISF note or the disclosures warranted under the new ISF note are applicable only if audit committee approval and shareholders approval are taken after 1st September 2025. So if suppose audit committee approval and shareholders approval both are obtained before 1st September 25, then new ISF note is not applicable. Even if audit committee approval is taken before 1st September and shareholders approval is taken after 1st September, still new ISF note is not applicable. But both the approvals, audit committee as well as shareholders, if they are taken after 1st September 2025, the entire disclosures and all the obligations of disclosure under the new ISF note are applicable. Now, SEBI has gone further in clarifying the exemptions as well, although some of the exemptions are quite obvious, but it has put it in so many words to put the things, bring in the adequate clarity, where all the transactions which are exempted under regulation 23(5) are exempted for this purpose. So first of all, what we need to understand here on ISF note in terms of disclosure is that this disclosure triggers when either you need the audit committee's approval and or shareholders approval as well. So in case there is no approval needed of the audit committee or the shareholders, naturally the disclosure requirements under the new ISF note is also not applicable. That is exactly what is covered in this first bullet, where SEBI says that, where the ISF note says that transactions which are exempted under 23(5), the ISF note is not applicable. Which are the transactions covered under 23(5)? As I said in the beginning, transactions between listed company and a wholly owned subsidiary, and transactions between two wholly owned subsidiaries are exempt from the approval requirements. Now, once in case, as I said in the beginning, that audit committee is empowered to grant omnibus approvals for the transactions which are repetitive in nature and which happened throughout the year. Now, once any such omnibus approval is granted for any transaction, then any transaction happening within the omnibus approval for a financial year are required to be tabled before the audit committee at every quarterly meeting. So during the quarter, whatever transactions have happened within the omnibus limit granted by the audit committee, those are tabled at the audit committee for its review. Now, because these are only the transactions put before the audit committee for review, for this purpose, again, ISF note is not applicable, because ISF note will be applicable at the time of seeking approval, not at the time of subsequent review. Okay, and then any related party transactions where the value of the transaction means one transaction or all the similar transactions together during one financial year, if it does not exceed 1 crore rupees, then disclosures on ISF note are not applicable to such transactions. Moving on to the core of the disclosure requirements. As I said, new ISF note brings in a lot of clarity and it cuts down on the contents that are required to be disclosed. Now, there are three categories that are prescribed for disclosure requirements: Part A, Part B, and Part C. Part A, A1 to A5 are the categories provided, where basic details of the related party, nature of relationship, how that related party is related, the interest of the directors, KMPs, or promoters because of which this becomes a related party is to be given. History of previous transactions is also required to be given. So if suppose company is entering a related party transaction with related party A, and there is a transaction which involves sales of material, then transactions happened during the previous financial year with that related party, and the similar transaction also requires to be reported. Now, there is only one aspect that comes in, whether if suppose we are talking about transaction between listed company and the related party A, transaction involving sale of material, there may be a possibility that between the company and that related party, particular related party, there may be various other transactions also happen. Say, for example, reimbursement of expenses or lease rental payment, or availing or rendering of services, or any other transaction for that matter. If we are only seeking approval for a particular transaction, say for example, transaction involving sale of materials, and even if we are not seeking audit committee's approval for any other transaction for a particular financial year, do we need to still disclose all the transactions, or only the relevant transaction for which we are seeking the approval is something that remains to be a question. Going by the understanding or in view of the recent judgments that SEBI has passed, SEBI will look at all the transactions together with a related party, and even if a particular transaction is not relevant in a particular year at the time of seeking approval, in case it becomes relevant subsequently during the year, then there may be again a requirement of providing the history of previous transactions, and therefore a conservative or maybe ultra conservative view, we can say that a conservative view will be that the audit committee will be supplied with all the transactions that have taken place between company and a particular related party for which we are seeking audit committee's approval. Then amount involved in the proposed transaction, again the same point here. So when we talk about amount involved, same question, and the answer will be similar to what we have discussed for the history related aspect, that even if we are seeking approval only for one party, list of all the transactions happened in the previous year, and the amount of transactions provided should be provided to the audit committee as a matter of comparison. And then basic details of the proposed transactions. So this category A or part A of the disclosure requirements is applicable to every related party transaction. So every related party transaction where approval of the audit committee or the shareholder is sought, part A becomes fully applicable. Now, if we move on to part B, so the structure goes really like this. So part A is applicable to all the transactions. Part B is applicable to certain specific categories of transactions, and part C is again an incremental requirement on the transactions which are otherwise covered under part B. So if where part C will become applicable if the transaction requires approval of the shareholders because it is a related party, it is a material related party transaction. If suppose the transaction is only RPT which is not a material RPT, and the transaction is involved covered in category B or part B, which under the clauses B1 to B7. So I will just go through that list for the sake of clarity. The category covers is purchase, sale, supply of goods or services or trade advances, loans, advances or intercorporate deposits, investments, guarantees, indemnities or comfort letters, borrowings, disposal of assets or shares or investments, and royalty payments. Now, as I said, Part A is applicable to everything. Part B, which provides additional disclosure, is applicable for the transactions which are covered in the list under Part B, which we just read out. And if any of these transactions, which is covered in Part C, so if you look at compare Part B and Part C, you will see while Part B has 7 clauses, 7 blocks, Part C has only 6 clauses. What is missing apparently is sale, purchase, supply of goods or services, and trade advances. That category is not covered. What does it mean is that if the transaction involves sale, purchase, supply of goods or services and trade advances, then only disclosures under Part A and Part B is relevant. Part C, there is no prescription on that. Why that is left out? Probably because on those routine transaction, whatever is supposed to be disclosed is getting already covered under Part B, and there is nothing left additionally to be covered under Part C. Now, other than that, the list is identical, list is the same, and therefore, if there is any transaction which becomes a material transaction for which company seeks approval of the shareholders, then additional disclosures under Part C are also required to be provided. Now let us dive a little more into the details of these requirements. And I will not probably go verbatim unless it is required if there are any specific questions, but I will just share some thoughts around certain challenges around each of these categories. So if you see B1 clause here, it talks about sale, purchase, supply of goods or services and trade advances. Now the way the disclosure is warranted, it appears to us that trade advance is identified as a separate category of transaction. The ambiguity here arises is that if suppose a company seeks approval of the audit committee for transaction of sale of materials with a related party A, and the transaction value is say 100 crore rupees, the advance given once the approval is received from the audit committee and the transaction is initiated or is supposed to be implemented, company may pay some trade advance. Whether the trade advance payment of say 100 rupees is paid as advance, whether that is a separate transaction treated by the treated as a RPT, or it will be subsumed within the 100 crore rupees approval granted by the audit committee. The way the disclosures are warranted, it is covered. It appears that trade advances are required to be approved separately. While if you look at company law requirements, there is only a additional disclosure that is warranted of any advances to be paid under the approval that is granted by the audit committee or the board for that matter, as required under company law. But here, the way the it is structured or disclosure is warranted, it appears that trade advances is considered as a separate transaction, and therefore, in effect, for a transaction of 100 crore rupees, we end up getting 100 crore plus 10 crore of trade advance as approval. So that remains to be seen how we want to really cover it. The disclosure suggests whatever I just spoken about. Now, loans, advances, or intercorporate deposits. So when we talk about loans and advances, the additional disclosure requirement and the points which the company will have a lot of issues faced in disclosure is it requires us to provide sources of funds and purpose of utilization. So as far as the transactions are within the group, there may be disclosure provided. So the disclosure is required irrespective. So any loans granted, any advances given, or any intercorporate deposits, amongst other things that are required under para B, sources of funds, purpose of utilization is something that I find there will be some challenges. Purpose of utilization may be agreed today at the time of granting of loan, but because of practical issues, if suppose the money is spent on something else, what will be the consequences? Will it amount to a default on the terms of granting of loans or investments, and therefore have different consequences in terms of disclosure requirements? Is something that needs to be seen, because when we talk about disclosure on loans, investments, or intercorporate deposits, one of the clauses required under this part is also that if there is any default made by the recipient or the borrower in fulfilling any terms of the granting of loan. So within a setup of loans between group companies, where there may be little flexibility that we may have today, some issues will come up as we move on and look at the issues more practically, and those will need to be addressed because of the additional requirements that are put in here. Sources of funds also, again, there may be some practical challenges. We can see that if there is some borrowing that company has, but company also has some the internal accruals available and cash flow available, how do you see whether the borrowing at that particular time will amount it to be sources of fund being borrowings or what? Because borrowings may be done, take a company may have borrowed funds with some other purpose specifically, or keeping in view some future transactions, but at that time some amount is granted as loan or advance is given or a intercorporate deposit is made. Then how do you justify that? Because of the fungibility, such issues may have to be practically addressed. And as far as we can envisage is one, but uh, even I believe that as we move into and actually start implementing these disclosures, starting 1st September, we may have more challenges and more issues coming up in terms of identification of exact disclosure requirements. Now, the next point is very interesting and may bring in some additional challenges as well on guarantees, indemnities, or comfort letters. So, the word used in the ISF new ISF note is comfort letters, and it also goes on to say by what your name called. So, which makes it quite open-ended, and in a very it's very common that in case of a group of companies where holding company issues comfort letters to the auditors, where auditors seek any clarification or input on the going concern of a subsidiary company. The auditor will treat a subsidiary as a going concern based on the confirmations given by the holding company by way of a comfort letter. Now, that comfort letter does not, whether it creates any legal obligation on the company, probably no, which is again also one of the additional requirements in terms of that, where one is it talks about what is the transaction, whether it is a guarantee, indemnity given, as surety given, comfort letter issued. That is a type of the transaction, and if yes, then whether this creates any legal obligation on the listed company or not, listed company or the subsidiary, because as we discussed, listed company as well as subsidiaries is also RPT. Now, in this case, where such comfort letters are issued, and as I said, because the wording used in the SF note is that says by what your name called, which makes it very clear on the intent of the industry standard forum or SEBI for that matter, that it has got a very wider coverage. Now, if coverage is wider, then the example that I gave of listed company issuing such a letter, calling it a comfort letter or assurance letter or whatever you name it, for confirmation on the going concern of a subsidiary company, then is it a related party transaction? Because it will not flow anywhere in your books of account. In the letter, you may or may not have wordings which say that this letter, while it is being issued, it is not creating any legal obligation on the company. What it covers is probably the reputational damage or reputational risk for the company. If at all this is considered as a related party transaction, one is that it does not get reflected in the books of accounts anywhere. Second is, if this is a related party transaction, because in the beginning I said that I'm emphasizing on obligation as well, right? So even if there is a transaction where there is no consideration involved, is also related party transaction. And transaction, even if there is no actual transfer of resources, but in getting into some obligation, also is a related party transaction. So going by that logic, coverage of comfort letters and the wider coverage because of by what your name called makes it abundantly clear clear on the intention why it is brought in like this. But how do you identify that? What is the quantum or what is the value that you will book and report and seek approval from the audit committee or the shareholders for that matter, if at all required, in terms of value that you are getting approval for. So this comes as a challenge. One view may be that the entire negative net worth of the subsidiary company therefore becomes your value of the transaction, but that may not be really the proper view, because if at all holding company has ends up supporting the subsidiary company in a situation, that may be that amount may be different from the net worth, because during at what point of time that will there will be a trigger, if there will be a trigger at all or not during the year, those remain to be the questions really. So in terms of comfort letters, this has to be identified, and we may have to really take a call on including on the contents of the letter that we are preparing, what should be that value and how we are going to place it before the shareholders or the audit committee. And shareholders may be a quite distant situation, because we are talking about identification of value is in itself is not possible to be determined. So a call needs to be taken on honestly. We have not been able to form a view on this as yet, but I just thought while we are in process of consuming the note, whatever are the issues that I have been able to identify, I'll just bring it here for the discussion. Now, disposal of assets and shares, I think there is no problem, except for the fact that the disclosure requirement goes on to even talk about the basis of pricing, valuation reports, etc. Sometimes in a very commercial deal, the price may be just a negotiated price, nowhere connected with any other logic or any valuation report as such. But then, as far as the disclosure is about the audit committee, before the audit committee, that may be given. But similar requirement is also there under Part C, where disposal of assets or disposal of divestment, so to say, if it amounts to be a material transaction, then disclosure on pricing becomes disclosure on pricing will become mandatory to be given in the notice of the general meeting where we are seeking approval of the shareholders, and companies may or may not want to disclose the price that is negotiated for a particular transaction. The next point is on royalty payments, next category. There, I think this, I believe, will be the most critical aspect. Not in terms of the disclosures requirement, but critical aspect in terms of identifying or collating the information that is required to be disclosed on royalty payments. Because royalty payments, as we can see, that it is part of Part B as well as Part C, and the level of disclosure that is required under Part B is that whether royalty charged by the holding company or the parent company to all its subsidiaries on an uniform basis. If there is a difference, if there is a deviation, or if different royalties are charged, then what is the minimum amount of royalty percentage or amount that is charged? What is the maximum percentage of royalty that is charged? All those things are required to be disclosed. If we just take a glance on the coverage so far on the various transactions that are specified under Part B and Part C, we can see that there are some apparent exclusions or exceptions. The apparent exceptions are really the other type of possible RPTs, which is reimbursement of expenses, remuneration for promoter people or individuals belonging to promoter or promoter group. Then will be a CSR contribution made to the related parties. Similarly, charitable contributions, donations, etc. So what happens to those transactions? Because those are not covered as Part B or Part C under Part C, then naturally only Part A becomes applicable, because as we discussed, Part A is applicable for every RPT. Okay. Moving on to the additional specific requirements. So we spoke about the difference between Part B and Part C, and the sale purchase transactions are not covered in Part C, so that is saved. Primarily because everything that is relevant is already covered in Part B. Now, in terms of loans and investment, or loans and advances or investments, one of the important aspect that comes out, and I was not able to really conclude on it, which is requirement of credit rating. Now, at the time of granting any loans or making investments, the credit rating of the other party is required to be given. Now, there is no exception brought in for transactions within the group or outside the group, means within the group, subsidiary companies or outside the group or any third party. This really creates little ambiguity in terms of the requirement of getting credit rating. Now, in terms of investments, although the ISF note clarifies to say that for investments, credit rating is required only if the investments are being made in the debt securities. So, because of this prescription of debt securities specifically, we can assume that investments made in equity instruments or non-debt securities is where credit ratings are not required. But wherever investments are being made in debt securities, credit rating is required. Now, whether ISF note therefore overrides the requirement now and mandates taking credit rating even for private companies or the group companies or foreign subsidiaries of the company, how will that fare? How will that work out? We will also need to be seen. Apparently, basis the coverage, the answer is simple from my point of view that credit rating is required. It doesn't stop there. It also says that credit rating, one is it is mandatory. Second is it should be latest credit rating. Now, what is latest credit rating has not been defined. So we'll have to take a view as to what credit rating. Latest credit rating means latest credit rating that is obtained by the company. So if a company, the borrower or the investee has got the credit rating in 3 years back and that is the latest that they have, or latest means they have to necessarily get a latest credit rating done if they are seeking an investment or borrowings from a listed company to which this ISF note applies, that needs to be seen. Logically, it can't be 3 years old credit rating. It has to be latest credit rating. But then still, what that latest means, 6 months older, previous years, current years, what exactly it will mean by latest, that also will have to be seen. Now, in terms of additional requirements on guarantees or similar commitments, comfort letters, there will be some additional questions or additional challenges. So when we talk about comfort letters or even for that matter, guarantees or what happens to the guarantee commission. So from accounting point of view, the moment we give guarantees or we give comfort letters or we provide sureties, for it to be an arm's length transaction, there should be some component of guarantee commission, etc. Now, whether the particulars around what will be that guarantee commission, that also will have to be provided. The similar question will arise if guarantee amount is X, guarantee commission is 10% of X, whether X plus 10% of X becomes your approval threshold, or only X is the approval threshold and guarantee commission related disclosure is only an additional disclosure. That also needs to be evaluated. So unfortunately, you may feel that I'm just bringing out the issues and not having answers as conclusions, but that is unfortunately the fact today, because we are just evaluating the things, and as we are moving ahead in evaluating all the requirements is where these points are getting evaluated, and over the period probably we'll end up taking some views on this. Plus, in case of guarantees, maybe accountants will have a clear answer. I don't have an answer here. When does the guarantee becomes a related party? One answer based on the emphasis that I made on the term obligation. The moment we give guarantee, that becomes our related party transaction. But if suppose subsequently the guarantee is invoked in a subsequent year, then what happens? Whether subsequently during the year or the subsequent year, invocation of guarantee, that is where we'll have probably after the invocation it will come to the books, whether it will again be a separate transaction or it is already covered because guarantee of a particular amount is already approved by the audit committee based on the shareholders if applicable. That would be enough or not. Those are again the questions that will come in. But as such, the moment, even if invocation of guarantee is subsequent, but at the time of guarantee being given, from the pure definition of RPT, it becomes a related party transaction in itself. The question is only if there will be a dual impact or only a single impact at the time of issuing the guarantee or giving the guarantee, or at the time of issuing guarantee as well as at the time of when the guarantee gets invoked. So that is the point. Now in part C, again, royalty related transactions, the additional disclosures that are there, which may be very difficult for companies, and I'm still trying to get a sense as to what information will be available, what can really be made public, is it possible or it is not, because what all is required additionally under para C for royalties is that percent one is the part C requires the historical data for previous 3 financial years on payment of royalties. It also asks for relevant data of company's turnover, net worth, and income and the profits for past 3 years. It also asks us the comparison of increase in the percentage of royalty vis-a-vis increase in percentage of the turnover, net worth, etc. So those are incremental disclosures. Going beyond that, what is also asked for is the peer comparison. So whatever is the royalty paid for various categories or various categories of instances, and then identification of 3 peers from the same category or same industry, and what is the royalty percentages that those peers have charged. That is all again required to be disclosed. Now, based on my limited understanding or discussions on this particular aspect, a lot of this information may not really be available for us to be provided. Now, apart from availability, there may be concerns on the confidentiality as well, or not only on royalty, but any matter which amounts to being a trade secret or confidential matter from the point of view of any aspect connected to business. Say, for example, we were discussing about making investments or disposal of assets or divestments or investments, acquiring M&As or acquiring businesses or entities. In that case, there is one clause that new ISF note provides, where it says that while the information should be provided to audit committee irrespective, for it to be provided publicly, which is the case in case of material RPTs where approval of the shareholders is required, and therefore the disclosure to be made in the explanatory statement. There, in case the company or management is able to justify that why a particular information is a trade secret or confidential and cannot be disclosed publicly, or it will have adverse impact on the company, and if audit committee is convinced, then audit committee can take a note of this aspect and allow the company to not disclose certain information under these requirements in the explanatory statement, which is available publicly. So that also additional clause that is available. Now, in terms of other key aspects, there may be some additional issues as well. So, for example, conventionally, when we look at RPTs, because company law, if we compare for the moment, that company law provides for requirement of shareholders approval, it provides specific threshold per transaction, so transaction wise. So there is a different, for sale purchase related transactions, it is a threshold of 10% of turnover of the company. For sale or disposal of assets or purchase of assets, the threshold is 10% of net worth of the company, and so on and so forth. So there are different thresholds that are provided category wise. So transaction wise limits are provided. So therefore, the basic understanding would be that when we talk about RPT, so transaction between listed company and party B and sale of goods is one transaction, and materiality threshold as such should be applied to this one level. So if suppose with party A, listed company has sale of goods, rendering of services, reimbursement of expenses, and lease rental, all these transactions will have to be looked at independently in terms of determining whether the transaction is material or not. That can be one view, or going beyond that, because as I said, I emphasized on under a contract. When we looked at the definition of RPT, it says that one transaction or all the transactions together under a contract. So when we say under a contract, so if suppose there is a contract that is entered into by the listed company with a related party, which covers sale or purchase of materials, availing or rendering of services, and the connected reimbursement of expenses. Now, even if there are these three different categories of transactions between the company and the listed company and the related party, all these transactions are done under one contract. So therefore, for materiality purpose, all this will be clubbed as one, and materiality threshold of 1,000 crores rupees or 10% of annual consolidated turnover may have to be attributed. If not under the same contract, there is a view possible. There was a view possible, I would say, that each of these different line items with a particular related party will be looked at as per party, per transaction, per financial year for materiality thresholds. In a very recent matter, in Linde India's case, SEBI has taken a view that, and probably this was a view, predominant view in the market as well, that when determining the materiality threshold for related party transactions, all the transactions together clubbed with a particular related party should be looked at from the materiality point of view. Now, this will create some issues for us, because the moment, so take for an example, that materiality threshold for a company is 100 crore rupees, based on the criteria of materiality 1,000 crore or 10% of annual consolidated turnover, and a company has multiple transactions, various transactions with a related party A, and out of that, say lease rental is only 1 crore rupees, availing reimbursement is again 1 crore rupees, but 99 crore rupees of sale transaction. Now, because 99 plus 1 plus 1, which are 1 crore, is a very small amount, even we look at the 10% materiality threshold, all these transactions would amount to be material RPTs, because then we are clubbing all the transactions together based on the Q taken and the interpretation of the definition of related party transactions. Now then the question arises that all the additional disclosures required, barring for the example that I gave on the reimbursement of expenses, but other transactions will be covered here. So in that case, whether this extensive disclosure is required to be given or made even for a transaction the value of which is only 1 crore rupees against the materiality of 100 crore rupees, that remains as a question. A practical view may be that only disclosure is required for a transaction which is crossing the materiality threshold, which is none in the example that I have given. So does it mean that no disclosure under Part C is required, even if we are practically reaching out to the shareholders seeking approval of the shareholders? So if we have to just tweak the example given earlier, so instead of 99 rupees of sale transaction is 110, and we have 1 crore each of reimbursements and availing on rendering of services. Now we have, this is 112. So in this case, probably we can clearly take a view and say that only the transaction out of all the transactions, while approval will be sought for 112 crores, but when it comes to disclosure under the ISF note, will be applicable only for the transaction of sale which crosses the materiality threshold. But then, as I said in the said earlier, if none of the transactions cross materiality threshold, but all the transactions together cross it, then how do you go for the disclosure will have to be seen. So we may simply end up taking a conservative view because of the view of clubbing all the transactions on materiality, but then there is other view possible as well. So these are some of the issues that were there. I think I have covered everything that is there. In case there are any questions, probably we can take the questions now, and then move on.
So there's a question regarding approval already taken for transactions for 25-26. What additional needs to be done, where omnibus approvals are taken?
No, so I think, as I said, new ISF note provides a lot of clarity on this situation, and it says that if any transaction, so a listed company would probably take all the omnibus approvals before the beginning of the financial year. So in the month of March 2025, the company would have taken approval of the audit committee for omnibus approval for entire financial year 25-26. In that case, as far as there is no change in the approval already taken, and that change, there is no additional requirement for till March 2026, and in terms of any additional disclosures under the ISF note. But if suppose the approval was taken earlier for the entire financial year, and there is a change in the approval that was taken, or there is any incremental change or any material modification there, because of which the company will need to go back to the audit committee, and that happens after 1st September 2025, then all the disclosure requirements under ISF note are to be provided to the audit committee.
The next is, can you guide a bit on guarantees, indemnity, comfort letters? Is the guarantee indemnity comfort letter issuing company required to record as contingent liability and any implications thereof? So basically,
I
this
think
is regarding the
on recording, yeah, I understood. So, while I'm not expert in accounting, but as far as I understand, nothing is required. So it depends on possibility, remote possibility, remote possible or probable, right? So if the invocation of guarantee is remote, then nothing is practically required. And I may stand corrected because I'm not accounting expert here, but if there is a possibility, then you record this as a contingent liability, and if it is probable, that is where you create a provision for that. So I think accounting will go on these lines, and therefore in such cases there may be some questions as to dual impact or duplication of it being treated as a RPT. As I said when I was talking about guarantees, at the time of giving the guarantee, because it is creating an obligation, that is a related party transaction, and when it actually becomes a liability, or it comes to your books because you create a provision for that, once the guarantee is invoked, that will be a second instance of it. So that is the ambiguity that remains even now.
Thank you, sir. So maybe we can proceed with the lectures. We can take the questions later.
I think there are no further questions. So if there is anything.
Okay, so there is one question that I can see where it says, where it is asked that we'll also call RPTs for non-listed entities too. Yes, so because we are saying RPT includes the transactions of the subsidiary companies, whether the listed company is a party to it or not. Therefore, a subsidiary company which is not a listed company, and it is entering into a transaction with its related party or related party of the listed company, then that is also required to be, that will also be covered for these disclosure purposes. One of the points that I have not touched upon during my discussion is the requirement of certifications. So there are additional 2 points that I would like to mention here before we close the and look for other questions. One is the earlier ISF note, which was the original ISF note brought in February 2025. It spoke about certifications being given by not only the management of the company, means the KMPs and the executive directors, but also by the promoters. So that was found to be quite an onerous requirement, which is addressed in this new ISF note, where certification is not totally done away with, but the certification to the audit committee is required to be given by the CEO and the CFO, and certification should be about should be confirming that the transaction is in the interest of the company and there is no conflict of, there is no undue benefit to any related party. And so which basically it confirms that the transactions at arm's length and are in the ordinary course of business. So that certification has got additional clarity. Now, when we talk about this certification, there remains a question as to, in case of a transaction where listed company is not a party, means the transaction between a subsidiary company and its any related party, who gives this certificate, whether the certification should be given by the CEO and the CFO of the subsidiary company or CEO and CFO of the listed company itself. The answer to this is, I think, straightforward, because the ISF note applies to the listed company. We are looking at approvals of the audit committee of the listed company, and therefore whatever is placed before the audit committee of the listed company should be certified by the CEO and CFO of the listed company, even if listed company, irrespective of the listed company being party to it or not. While issuing such a certificate, the CEO and CFO of listed companies may rely on a back-to-back certification given by the respective subsidiary company, but that will be the primary responsibility is with the individuals or officers of the listed company here. Second is, as I said in the beginning, there is a valuation requirement as well, which is about valuation reports of the obtained. So now there are questions whether valuation report is possible to be taken when we are seeking omnibus approvals or it is not. So in case of omnibus approvals are the repetitive transactions which are generally done based on the historical information and the previous year's transactions. And because those are repetitive known transactions, there is no valuation involved there. What is involved is a confirmation that these transactions will be at arm's length and in the ordinary course of business, thereby being in the interest and not having any conflict or any undue benefit to any of the related parties. But in case there is any specific RPT, say for example, purchase of assets, sale of assets, investments, in all these cases, there cannot be omnibus approval granted because these are specific transactions and one-off transactions and not the repetitive transactions happening during the year. In this case, valuation may become relevant. And what ISF note requires is that such valuation reports, when company is seeking shareholders approval, such valuation reports should be hosted on the website, and company should provide a QR code for accessing for enabling the shareholders the access to the valuation reports hosted on the website. So this is, I think there is no exception or exclusion given here, except for the exclusion that I spoke about of confidential information, etc. But companies have to start including this practice as well of providing additional block of information on the website, and QR codes and access codes are provided to the shareholders of this information.